Hi there, welcome to Nepi Invest. About 4 years ago, I had the thought whether or not a completely passive approach could completely beat the market. So it means choose about 20, 25 companies at a single point in time, and would those 20, 25 companies as a portfolio beat the market? So I came to you and asked you to provide me with a list of companies that you think would beat the market over a 5 year period. I got quite a few responses, interesting group of companies, and then I collated the results and came up with a hypothetical portfolio that I could track via Share Site. Now, we've got 1 year to go in this exercise, so I thought, why not see how this group portfolio has performed over the last 4 years? Now, don't forget, this is a completely passive approach, so no trading of companies in or out. And I'll also mention that two companies that were chosen by you have been bought out, so they're no longer trading on the ASX. Those two companies are Unity Group. Nice little reminder of that company. I almost completely forgot about that company. And Tesseract, another company that I've almost completely forgot about. Now, what I'm going to do is go through these results, how this portfolio has performed, and then also mention some of the takeaways I have or have been thinking about, maybe not thinking about, but some of the takeaways you can take away from the group portfolio performance. And it has not been a good 4 years because the group portfolio has gone down 9.5% per year versus the STW, which has gone up 8.4% per year. So what I've done here is I have grouped the portfolio by percentage change. Come on. It's supposed to be increasing in size. There we go, increasing in size. Anyway, there it is. So 9.5% down over the last 4 years. That does also include dividends. So capital gain, in fact, down 11.54%. So overall, this portfolio has not performed well. So what I've done is I've listed this the group of companies or this portfolio by return. So in fact, the best performed company within this portfolio has been Unity Group, a company that has been bought out. So 11.61% return. So over a 4 year period, the very fact that that company has been the best performing company within this group of companies is not a good start. Now, if we go down and have a look at those companies that have had a positive return over the past 5 years, you'll notice a common theme. Soul Pattinson, A2 Milk, Xero, ResMed, BlueScope Steel, Fortescue, and BHP. And just behind them, we have Woolworths, which is only down slightly, 0.26%. But definitely there is a common theme. These are real companies, bigger, or in fact, I would say bigger, better companies. And most of these companies do provide their shareholders with a dividend, all except one, and that is Xero. And Xero has hit that inflection point and is now profitable. And there's a chance Xero will provide their shareholders with a dividend within the next 5 years. Now, I'm a little bit surprised that some of these companies have not performed as well as what we have seen over the last 4 years. For instance, Xero has gone up 50, almost 100% since I bought in, and only up 6.67%. But don't forget, back in the middle of 2021, when I started this exercise, that was just before we started to see interest rates rise. So some of these companies were at a peak in share price back then, and they then dropped a fair bit, and now they're starting to rise. In fact, I think Xero might be at all-time highs. Now, I do like a few companies in this list, and I also say among the list of best performing companies, there are a few high-quality companies there. I'll consider Soul Patts to be a high-quality company. I consider ResMed to be a high-quality company. I probably would consider BHP not to be a high-quality company just because it's mining, but among mining companies in the world, it's by far the best. Maybe not by far, but definitely the best quality company. Some of the other companies here, A2 Milk's been in the war zone, did fall a fair bit back in 2020, 2021, has recovered and looks okay right now. Xero on the precipice of being a high quality company. I do have it in my long-term high quality portfolio. BlueScope Steel, not a big fan of that company. And Fortescue, it's an iron ore miner. And again, Fortescue fortunes will be highly dictated by the price of iron ore. And then Woolworths. down slightly. Some might argue this is a high quality company. For me, it's not, just because of the lack of growth. I need to see a higher revenue growth for me to consider a company to be high quality. It's defensive. And if you held Woolworths over the past 4 years, your returns have been flat. That's one of the reasons why. We'll also say it's actually quite expensive. In fact, Woolworths has been quite expensive over the last 4 years. So even though it's still expensive, share price hasn't really pulled back all that much. Okay, so now on to a second takeaway from this list of companies. Let's go all the way down to see the worst performing companies. A company called Imogen Biosystems. I don't know anything about this company. That's almost down 76%. Lake Resources, Point Terra, Ares Resources, Novonix, Alcidion, Talga Group, Province Resources, Email Payments, Credit Intelligent, Kogan, Zip, BrainChip, Dusk, Tezzeret, which is now off the ASX, Megaport, CSL, Arctus. They're all down. Well, not all of them are down a fair bit, because Arctus has had a nice little run over the past few weeks. So it is only down 1.63%. But only a few weeks ago, it would have been down about 30, 40, 50%. Also, interesting to CSL is in this list. Now, this just shows you, over the last 4 years, CSL's done nothing. Share price has gone sideways. So sometimes even high-quality companies can go sideways for a long period of time. But definitely there is a common theme in this group. Most of these companies I would consider either story stocks or low-quality companies. Imogen Biosystems, no idea what they do. Definitely a story stock. Lake Resources, definitely story. It's a lithium exploring company. Point Terra, I still think it's a story stock in a way, because they haven't reached profitability, but they have been showing promise. But whether they sort of prove their promise to the market and themselves and everyone else is or remains to be seen. Ares Resources, they are a copper producer, but they have disappointed on occasion. Novonix, still think that is a story stock. They have a little bit of revenue, but still a long way from profitability. Alcidion does look interesting. So Alcidion is starting to look interesting because they've released a few positive reports. And even though share price is down 28% since 2021, I think this company might be on the move. Talga Group, still a story stock. Province Resources, no idea what this company does. That's definitely a story stock. Email Payments was in the walls a few years ago. Share price is now starting to recover. So I do think this has potential to climb from the depths of despair. Credit Intelligence, again, shoulders up again. Kogan has been disappointing. Zip is on a tear. So I think maybe Zip was bought. If you go back to 2021, maybe Zip was bought near the top. Near the top. And that's another thing you'll notice about some of these companies. They were bought because they were highly hyped back in 2020, 2021. So if you go back to, the share price of Zip reached a high in February 2021 and had pulled back. So I think a lot of people chose Zip because the share price had pulled back from about $14 all the way to $8. Currently now it's $4, but it is on the way back. It does look a little bit more promising now. So that's another thing you can take away from this group of bad performing companies. Quite a few of these were in the news back in 2021. These were hyped up stories, hyped up stocks, and it has gone completely in the opposite direction over the last 4 years. So that's another thing we take away. Don't fall for the hype. So a lot of companies will go through hype periods, but the problem is if they do go through hype periods, there is a chance the share price could collapse or fall away if they don't prove that hype. So in my opinion, those sort of companies are more trading stocks. They're not the sort of company you want to own for the long term. Even those companies like Alcidion and even, Arctus, they were sort of in the news. They were hyped up back in 2021, but it's taken 4 years to prove a little bit to the market. And even Arctus hasn't really proved anything just yet. They're still way away from being profitable, but they have released some really interesting announcements in the past few weeks, in the past week or so. So that's another thing you can take away from this, that sometimes story stocks and low-quality companies are more like trading stocks. They shouldn't be the companies you own for the long term, because you can see some of these companies' share price is down a fair bit. Okay, another thing I'm just going to mention is if you have a look at the value of some of these holdings and just compare the best performing companies to the worst performing companies, you'll notice that the companies that performed really badly, the valuation of, the holdings, the valuation of their holdings in this portfolio are fairly low. So, for instance, Pointera is down to $432. Ares Resources is down to $390 because the company has performed so badly. But if you go to the top of this list, some of the companies that have performed fairly well are now a much bigger proportion. That's the best way to say it, a much bigger proportion of the portfolio. And if they continue to perform well, because they'll rise in percentage of the portfolio, there's a chance that this particular portfolio's fortunes will shift to being more positive than negative. And that is a really good investing strategy. I do know some people use that. So they will never sell out of the bad performing companies because eventually they'll become such a low proportion of the portfolio that those companies won't affect the portfolio performance. But if you hang on to your winners, those companies, proportion of your portfolio will go up and up and up. And if they keep on performing, you'll see a pretty good rise in your portfolio. So that is probably one of the benefits of having a complete passive portfolio. Now, it all depends on which companies you initially choose, but there could have been one company. There's a scenario that you could have chosen one company that has gone up 700% in the past 4 years, and that would have actually saved this portfolio. Could have gone up 1,000% in the last 4 years, and that would have meant this portfolio probably would have beaten the benchmark, which is the STW. So I think another thing I can take away from this is just maybe there was a bit of unluckiness in this because there was not one company that performed really, really well over the 4-year period. And typically, if you choose between 25 companies, usually one of those companies would have performed really, really well. Maybe Unity was that company. Okay, and so that's another thing you can take away, that I think eventually this portfolio would or will perform at least to the benchmark, maybe even outperform the benchmark. So what you could do is just have a look to see how this portfolio has performed in the past year. So let's have a look in the last year. How has this portfolio performed? And total return in the past year, 12.93%. Compared to the benchmark, 16.14%. So it is starting to turn around. And you can just actually see that if we have a look at the last 2 years. If you have a look at the last 2 years, only up 0.36%. But definitely the downward slide in the performance or the valuation of the portfolio has come to an end, because if we go to since first purchase, you can definitely see the valuation of this portfolio going down, and now it's going sideways and even upwards. So I do think now is the time that this portfolio maybe can outshine the market, because those bigger companies are now bigger, better companies, the higher quality companies are now a bigger proportion of the portfolio. And those crappy companies are hardly a thing, hardly a percent of this portfolio. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.